It's Market Monday. This week we talk about the new Housing Affordability Trust Fund that Bluffton just signed into. The Gen Z people, they don't want to go back to work. Mortgage rates are the highest in decades. David Crowell comes in to talk to us about that. And Ron Maver and I, we talk about the Bluffton numbers this week on Market Monday. Hey, did you hear about Bluffton signed an agreement, a trust agreement with several other towns and counties in our area, Yemassee, Hilton Head Island. Bluffton just signed it.
Yeah, huge issue here. Affordable housing. People have to live on the island. They have to work on the island. Where do we go? It's been a problem that we've had, and it's ongoing, and it just continues to seem to get worse and worse.
Is this agreement going to change anything?
I'm skeptical, Dan.
Yeah.
I know this may get me in trouble, but anytime I see an agreement with this and it has 8 different entities, that tells me it's hard to get 8 different people to agree on anything.
Yeah, I mean, they're committing what amounts to me is to a small amount of money to a shared fund that they can have some influence in. But listen, any step in the right direction, no matter how small, is a step, and we shouldn't discount that.
No, I'm not discounting. It may get me in trouble.
But this is not a game changer.
It's not a game changer.
Not a game changer at all. But good news. Good on you, Bluffton, for signing it. One thing I didn't understand in reading it was his Hilton Head signed it. So I'll look into that and find out whether Hilton Head signed it. It says Hilton Head was on the agreement,
but nothing.
But in this article, it only says, and this was on the 28th, that when Bluffton got it, Yemassee and Hardyville had signed it. So now it's Yemassee, Hardyville, and Bluffton that we know of. The rest, I think we're guessing. Gen Z driving most of the workplace trends. Fortune has really put some interesting articles out recently. This is what I thought was a fairly interesting article.
It talks about Gen Z taking over the workplace, but there's good reason we should still listen to the millennials and the baby boomers.
Yeah.
And particularly in our industry, the real estate business. Why is that? Well, as you have millennials moving in and boomers, 1, they're the 2 biggest populations. 2, they're the most likely to move. You're looking for boomers that are looking to retire, the downsize, move to Hilton Head, get better weather. And then you also have millennials that are just starting families, trying to figure out their way in life, trying to figure it out. Me, I'm a Gen Xer. Most of the people in my age range, with the exception of me, who went and moved 2.5 years ago, have kids in the school system, have settled, are moving in. Gen Z, they're not quite there yet. They're just working their way through the workplace, starting to save, starting to look for places to settle down. The also interesting thing about Gen Z is they may never settle down. They don't have an office to go to. They don't have a workplace. They don't have any commitments. They shift jobs quite a bit.
Yeah.
They're totally changing the way the world looks at it. They've made living in a van cool.
How does this impact Hilton Head if it does? Like, does this generation that intends to always work remotely, does that help Hilton Head Island? Are like Gen Z people actually buying on Hilton Head Island? Or like you say, are they just parking down in Caligny in their van?
Good thing there's no overnight parking, so it kind of forces them to buy. But I think it can only help Hilton Head. I mean, if you have your choice of places to live, why on earth would you not pick here?
But are we also seeing industry like kind of pushing back on this work from home thing?
Oh yeah, and I think you'll always see that. Well, particularly now, because most of the people in management positions and ownership positions are an older generation and pushing back. But as time moves on and transitions switch and Gen Z starts moving into those management positions, you may see it become more and more popular.
Yeah. The big question that comes to my mind about all of this is data. So if anybody watching this has any data and you can pass it our way, I personally really appreciate it. It's hard for me to believe that people can work from home and be as productive. I think there has to be an assumption that productivity drops a little bit, but also expense for a company drops quite a bit if you don't have to have commercial real estate to house all of these people. It's like a huge financial savings for these companies. Do they wash each other out? Is the savings on commercial space enough that you could hire more people to reach the same level of productivity across your organization? Is that the trade-off?
I think that's a trade-off. I think part of it comes down to being able to retain your workers, keeping them happy.
Yeah.
We've seen a shift in, again, generational shift where the younger generation has put more and more emphasis on their own happiness. So in order to keep them happy, do you get them more productive if you keep them at home? I mean, only time will tell.
We're coming out of this pandemic and we have a huge labor crunch in this company. So the worker now holds all the cards, right? But what happens when there's a shift and maybe there's some layoffs and there's more people out there and it's a more competitive market in terms of workers competing with each other for jobs? Is it just that worker pool is so out of balance with what companies need in their staff for staffing? Like, is it just out of balance funds. And so we're seeing this unequal power on the side of the workers.
I think that's a fair statement. I think it's a fair observation, and especially in the real estate market, things work at ebbs and flows, and maybe it shifts back a little bit to the companies as you described. Workers become more and more needed, and then we can kind of figure out where is a happy medium.
Things balance out.
Yeah, of course.
They always seem to find level again, don't they? Next is time to talk about mortgage. So let's bring in David Crowell for our Mortgage Minute. Great article this week that we want to ask David about. The news article, the headline is mortgage rates hit their highest levels since the peak. I know you want to talk about this.
Not really. This article was published on October 5th, and they've gone up another 0.25%.
Wow.
The interesting thing about the interest rates is not just that they're much higher than they were in January of this year. They're 2.5 times higher than they were. 3% on January 1st, 7% today. That's high relative to what? That's high relative to where they were, but not relative to where interest rates have been for the last 15 or 20 years. Average interest rate has been 6.25%.
Americans have such a short memory, though.
I understand. So last thing I want to be in life is an apologist for interest rates.
Sure. I mean, you don't control them, do you?
The interest rates are high, they are extraordinarily volatile, as is the stock market, as is the inflation rate. The Fed is trying to force inflation down. All of these are extremely volatile indicators. However, as you guys were just saying, real estate inventories are extremely tight, and demand, not universally throughout the country, but certainly demand in the Southeast, is extremely high. So you have these really, really strong indicators of tight inventory and enormous demand, which means that prices will stay solid, which means that the marketplace is going to enjoy a positive momentum for as long as we can project, certainly 5, 6, 7 years.
Is that why the Fed's guidance is so aggressive on this, is that they feel like they don't have enough gunpowder to deal with this?
The problem is that they have one gun. It makes their activity dangerous because they always end up overshooting and causing briefly a recession. The indications for this marketplace are, as soon as we see stability, it really doesn't matter. I know to anyone watching that it matters whether stability is at 7% or stability is at 6% or stability is at 5%. But believe me, it doesn't matter. As soon as these indicators reach stability, which they should within the next 3, 4, 5 months, the fundamentals, which are that there isn't enough inventory for the demand, will reassert themselves, and everybody will proceed with a boom mentality all over again. It really doesn't matter what the core interest rate is, as long as it's stable.
Is the fact that there is so much volatility right now, is that an indication that they're getting close to having a desired effect, or is it just...
It's just where we are in history. Yeah, it's just where we are in history. There's a war going on. There's an enormous energy crisis caused by that war. That energy crisis is rippling through Europe at the moment. The inflation rates in Europe are going through the roof. Bank of England had to come to the rescue of the pound last week. I mean, it's chaotic.
Yes.
We are stronger financially than we've ever been. So as the reserve currency, everyone's flocking to dollars. Interest rates really and truly should be at about 11% right now. They're actually at high 6s, low 7s.
Is there something, we talk about the negatives of a rising interest rate, is there something positive or something positive that a buyer can take out of it and use it for their own advantage?
Yes. You need to stay engaged in the market. Basically, there's a string of negatives. Interest rates are relatively high and volatile. The Fed funds rate is going up and is in the news. Inflation is high. This is precisely when a buyer should be engaged in the market. The right thing to do is to be engaged and buy at the worst possible moment when everybody else has left the market. Then when the opportunity comes, you're going to be able to pump interest rates don't matter, because if the inflection point is at 7% where they stabilize, and that's when you pop, 2 years from next Tuesday, we'll be refinancing you at 4.5 anyway.
But the thing is that house that you buy at a 7% interest rate for $700,000 today,
Yeah.
that you refinance 3 or 4 years from now at 4%, you bought for 7%, but its value is now $1 million.
That's correct. You also moved ahead with your life and
Yes.
your life plan.
Yes. Once again, you're a wealth of knowledge, and I appreciate you coming in and talking with us about mortgages. It's I know I find it helpful, and I really
Super.
appreciate it.
Well, thank you very much.
Thanks. Man, David, talk about somebody that knows what they're talking about.
He just has a way of making things seem right.
Thanks, David. Mailbag this week, Rita asked, I was in Bluffton before it blew up, and then I fled to Ridgeland. Now I'm seeing things out here that were happening in Bluffton before it grew so much. Am I going to have to leave Ridgeland now to get some peace and quiet?
I guess it's all relative. Coming from
Yeah.
the city, I feel like I'm in peace and quiet.
Yeah.
But, following the trend, it's only natural that as we have expanded, it's become more and more popular. We've seen the huge development in Bluffton. Common sense would tell you it is going to start moving out into Ridgeland and Hardyville and areas like that. However, they're still rural. I think there's always going to be pieces of it being, quiet and farm-like.
Yeah. I think, Rita, it's time to get yourself a compound. I think Ron would help you, get yourself a nice 50 acres, put up a barbed wire fence, and keep all the yahoos, all the New Yorkers out.
A good way to look at it is there's still plenty of available land in Ridgeland. Start snapping it up now so you don't have any neighbors.
For sure, for sure. Well, hey, man, thanks for coming in.
Thanks for having me, Dan. It's always a pleasure.
All right, take care.